Okay, so you want to own a car wash. Imagine you already do. You found the busy road. You got the location. You built the tunnel. The equipment is installed. The brushes are spinning. The dryers are running. And now cars keep pulling in. One enters dirty. A few minutes later, it leaves clean. Another payment hits. Then another car arrives. Another payment. Water's cheap. Soap is cheap. And the same equipment can serve customer after customer all day long. No chef has to cook a new meal every time somebody pays you. No hotel room has to be cleaned after every customer leaves. No truck driver has to spend 10 hours on the road just to create one sale. Your customer drives in, the machine does most of the physical work, and a few minutes later you get paid. Then you make it even better. You offer a monthly membership. Now thousands of people can keep paying you every month until they cancel. Some come often, some come less often, but the recurring revenue keeps arriving. It sounds almost unfair. Exactly the kind of boring business people get rich owning. And apparently, some very sophisticated investors agree. In May of 2026, Leonard Green & Partners completed the acquisition of Mr. Car Wash in a transaction implying an enterprise value of roughly $3.1 billion. $3.1 billion for car washes. So maybe the fantasy's true. Maybe you really did buy an enormous machine for turning water and soap into predictable cash. Except there is one problem. A busy car wash can still be a terrible investment. Because while the customer sees 5 minutes of bubbles, you own everything behind them. Traffic, equipment, retention, leases, debt, capital spending, and later, one number will show why a 5-minute service can tie the owner to obligations lasting more than 13 years. But first, there is a more basic surprise. The car wash you think you own may not even be the same business as the one worth billions. Drive past an old self-service wash, a few bays, pressure wands, foam brushes, vacuums. Maybe nobody working there at all. One operator interviewed by Upflip built his strategy around finding neglected self-service washes, negotiating long leases and spending tens of thousands of dollars, bringing the equipment back to life. He described the product with one useful phrase: we're selling time. Keep the customer in the bay longer. Give them more functions to use. And the ticket rises. Now drive a few miles and look at a modern express tunnel. Automated gates, license plate recognition, a conveyor, multiple chemical stages, huge dryers, employees guiding vehicles, millions of dollars of infrastructure. Same dirty car, completely different economics. The self-service owner is monetizing time inside a bay. The express owner wants throughput, more cars, faster, again and again through the same fixed machine. And fixed infrastructure is beautiful only when enough customers use it. A conveyor sitting still does not become cheaper. A lease does not pause. Debt does not take the afternoon off, which means before asking how much one wash earns, you need to ask something more important. How many cars can this location actually pull into the machine? Because in this business, the first thing you are buying is not soap. It is traffic. Imagine 2 identical car washes. Same equipment, same prices, same employees. One sits directly beside a busy road with an easy entrance. The other is hidden behind another building and requires 2 awkward turns. Which one would you rather own? Operators kept returning to the same word: location. A car wash is usually a convenience decision. Most customers are not driving 40 minutes because your foam smells better. They see the wash. Their car is dirty. The entrance is easy. They turn in. Visibility has value. Traffic counts have value. Easy access has value. And unused capacity expires. If potential customers drive past today without entering, you cannot store those empty tunnel minutes and sell them next month. They are gone. But getting cars onto the property only solves half the problem. Once they arrive, the wash starts behaving like a factory. A conveyor moves the product. Sensors track its position. Chemical, brush, rinse, dry. Then, the next car enters. Factory output is cars per hour. You already have the site. You already installed the tunnel. You already have much of the labor. So another car moving through the same infrastructure can be economically attractive until something stops. A motor fails. A pump stops. A payment kiosk goes down. Cars back up. Some leave. Your best hour of Saturday afternoon does not wait for a technician. This is why automatic does not mean passive. Automation makes uptime more valuable. One owner described walking into the machine room as a new operator and seeing wires, hoses, pumps and motors everywhere. The customer sees bubbles. You see the machinery producing the money. And the largest operators found a way to make that money more predictable, even before the next car arrives. Suppose a driver buys one wash. You get paid today. Tomorrow, the relationship resets. Maybe the car is still clean. Maybe it rains. Maybe they choose another wash. You need another purchase decision. Now, sell that driver an unlimited monthly membership. The question changes from, will this person buy another wash? To, will this person cancel? At the end of March 2026, Mr. Car Wash had approximately 2,468,000 Unlimited Wash Club members. Roughly 76% of total wash sales came from Unlimited Wash Club. About 3/4. The tunnel still cleans one car at a time, but the economic relationship is no longer rebuilt one transaction at a time. That changes a fixed-cost business dramatically. A slow day can reduce retail transactions without automatically eliminating the monthly membership relationship. But Unlimited creates a strange equation. Two members can pay the same price. One visits once, the other visits 10 times. Same subscription revenue. Very different physical usage. Every extra visit consumes water, chemicals, electricity, equipment life, and capacity. So the owner balances recurring revenue on one side and physical delivery on the other. A Florida operator put the trade-off simply. Single washes can be more profitable as individual transactions, while memberships provide recurring revenue and help stabilize the business. When weather hurts traffic, retail can maximize today. Membership can stabilize tomorrow. This is where the car wash starts, borrowing logic from gyms and software. Subscriptions, except every use still has to pass through an expensive physical machine. So if the soap is cheap and the subscription keeps renewing, where does all the money go? Start small. One self-service operator described his strongest location generating roughly $26,000 during a good month. That is the number people love. $26,000 from one small car wash. Then count what leaves. He said monthly expenses could run around $9,000 to $10,000. Rent, electricity, water, insurance, maintenance, described motors costing around $1,000 when they failed. Vandalism could create repair bills of several $1,000s. In a strong month, $26,000 against roughly $10,000 of expenses can still produce an attractive result. But notice how different the business looks now. We started with cheap soap and an automatic machine. Then property appeared. Electricity, maintenance, repairs, and that is one small operator. Scale the same basic business across hundreds of locations and the numbers become enormous, but the illusion remains exactly the same. So let us shrink the largest car wash operator in America down to $100 and see what actually survives. In the first quarter of 2026, Mr. Car Wash generated roughly $278 million of net revenue. Reduce that to $100. Roughly $28 went to labor and chemicals. About $41 went to other store operating expenses. Another roughly $10 went to general and administrative costs. That leaves around $21 of operating income. Then interest and taxes take another bite. At the bottom, net income was approximately $12 for every $100 of revenue. Still healthy, but very different from the fantasy. The customer pays a little water, a little soap. Everything else must be profit. It is not. The soap is cheap. The system around the soap is expensive. Property, labor, repairs, technology, financing. The customer experiences a few minutes inside the tunnel. The owner finances the system, capable of producing those few minutes reliably over and over again. And then the numbers get stranger, because the same business reported a Profitability figure almost 3 times larger than its net income. Which number should you believe? For the same quarter, Mr. Car Wash reported adjusted EBITDA of almost $97 million. Adjusted EBITDA margin was nearly 35%. That is a beautiful number. Now look lower. Net income was roughly $34 million. Free cash flow after purchases of property and equipment was approximately $33 million. Same company, same 3 months, almost $97 million. Then 34, then 33. None of those numbers is automatically fake. They measure different things. But a physical business cannot repair equipment with an EBITDA margin. It needs cash. During the quarter, Mr. Car Wash used roughly $46.5 million of net cash in investing activities, primarily related to property and equipment supporting greenfield development and other initiatives. The company separately reported roughly $41 million of growth capital expenditures and around $5.5 million of maintenance capital expenditures in its free cash flow reconciliation. Growth capital is supposed to create more business later. Maintenance capital helps keep the existing machine working now. But both consume cash today, which creates a dangerous question for anyone looking at a successful mature wash and thinking about building another one. How long does the owner keep investing before the new site starts, behaving like the successful locations in the presentation? The answer can be about 3 years. Imagine spending millions on a new location. The signs are installed. The tunnel works. You open the doors. It feels like the hard part is finished. Financially, it may only be beginning. Mr. Car Wash says new greenfield locations typically take approximately 3 full years of operation to mature toward average unit volumes. 3 years. Drivers need to notice the wash. Try it. Come back, join, stay members. The location has to build a habit. But while that habit is forming, the physical asset already exists. Employees need to be paid. Equipment needs maintenance. Lease obligations already exist. Marketing costs money. Financing costs money. This is why looking at a mature wash can be deceptive. You are looking at the destination. You did not watch the climb. And growth creates a paradox. More locations can create more long-term value while demanding more cash today, which means the owner needs reserves and financing. And you do not need a recession to see the problem. Sometimes all it takes is one bad November. One independent operator finished 25 saying his car wash. Business had grown for the year. Sales were up. Debt was being paid down. Then he described November. He said the operation lost roughly $15,000 in that 1 month. Earlier good months had encouraged the business to reinvest. Equipment was purchased. Spare parts were bought. Bills arrived later. Then revenue came in weak. The owners had to use cash reserves. That is what a healthy annual number can hide. A profitable business can still have a terrible month. And fixed obligations do not care. Now zoom out to Mr. Car Wash. At the end of March 2026, the company reported roughly $790 million of long-term debt. Current and long-term operating lease liabilities together were roughly $950 million. The weighted average remaining operating lease term was more than 13 years. There is the number from the beginning. The customer spends a few minutes in the tunnel. Some of the commitments behind that tunnel can remain for more than a decade. A strong location spreads those fixed obligations across enormous volume. A weak one receives many of the same bills with fewer customers helping to pay them. The conveyor may be automatic. The loan is also automatic. The lease payment is automatic. Those systems continue whether traffic does or not. And then one participant gets a vote that neither the owner nor private equity can control. The weather. Car washes have a strange relationship with weather. Road salt creates demand. Pollen creates demand. Dirt creates demand. Then rain can make customers decide that washing the car today feels pointless. Freezing conditions can create operational problems. Drought can create water restrictions. One independent operator said a few rainy days were visible immediately in the amount of cash collected. That matters because national averages smooth out a business that does not feel smooth when you own one actual location. There is no average weather at your wash today. No average road construction blocking your entrance. No average competitor opening 1 mile away. You own one real site with one real set of conditions. A national chain changes that equation. 1 week in one market does not automatically mean 1 week everywhere. And that reveals why scale is worth more than simply buying chemicals more cheaply. Hundreds of locations can actually change the value of the membership itself. Own one car wash and the membership is useful around one location. Own hundreds and the product begins to change. More locations make the membership more useful. A stronger membership makes the network more valuable. More locations create more opportunities to acquire members. More members create more recurring revenue. More predictable revenue supports more investment. More investment creates more locations. Then those locations can acquire more members. That is the flywheel. Scale also brings shared technology, purchasing power, better site selection, data in hundreds of operating locations, teaching the company what works. At this point, asking how much one tunnel earns begins to miss the bigger asset. The question becomes, how valuable is the system connecting hundreds of physical locations to millions of recurring customers? Now $3.1 billion starts looking very different, because Leonard Green and Partners did not simply buy hundreds of machines spraying soap on cars. Go back to the business you imagined at the beginning. You found the road. You built the tunnel. Cars entered. Soap sprayed. Money appeared. You were not completely wrong. You were just watching the wrong transaction. The visible transaction happens when the car enters the tunnel. The more valuable transaction may have happened earlier, when that customer stopped buying individual washes and started paying every month. In May of 2026, Leonard Green and Partners completed its acquisition of Mr. Car Wash in a transaction implying an enterprise value of approximately $3.1 billion. Attached to that physical network were almost 2.5 million Unlimited Wash Club members, and roughly 76% of wash sales were already coming through the membership program. The location feeds the tunnel. The tunnel delivers the service. The membership creates the recurring relationship. And the network makes that relationship more valuable. Get those pieces right at scale, and the result can be worth billions. So what are you really buying? Not a car wash. A recurring revenue network that happens to clean cars. If you want more breakdowns of the hidden economics behind businesses everyone thinks they understand, subscribe.